Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host
Andrew. Bills, here we are back again for another podcast.
We are back again, Andrew, and back again week in, week out, every week. Little caveat except for the week over Christmas that we're going to take off.
Exactly right.
Sorry, not the week. I think it's going to be a bit longer than that, but
maybe the month.
Yeah, maybe the month. So good opportunity to go back and have a look at and listen of the back catalogue of the 360 Money Matters podcast.
Yeah, absolutely. That's probably for everyone else. I don't know if I can listen to my own voice though. It's a little bit weird.
Fair enough. No, nobody likes listening back to themselves. But Andrew, tell us, what are we talking about today?
Yeah, so at the moment, interest rates are rising, in particular around the world, but in particular in Australia. And so this is generally a time where people start looking a little bit closer at their home loans. So you're looking at, what's the interest rate on my home loan? Is it still competitive? Should I be refinancing? So what we're talking about today is all about refinancing, things you should be considering, things that you should be looking at when you're refinancing from an overall, wealth creation perspective. And probably more importantly, we've got one real nugget of gold at the end, and probably the thing that you should be paying the most attention to, that people spend their least amount of attention to, and so that point's coming up at the end of the podcast, followed by some examples around that as well.
I love it. Just leave that little hook there to keep people engaged at the end. But you're right, it is the most important thing, and we've got some numbers, and it's interesting every time we run this calculation. It's absolutely phenomenal where this lands, and I look at it and it just astounds me, and I can't understand how this is not more front and center as part of the home loan discussion, but we'll get to that in a sec. Andrew, where do we kick it off?
I think the first point is probably the main driver and the main reason behind most people looking at refinancing their home loans, and that's the interest rate. It's pretty simple, pretty easy. If you're paying 5.5% with your existing lender and other lenders offering it at same home loan at 5%. Naturally, that's the first thing that people jump to, and that's the first thing that people look at and say, hey, time to refinance, time to move to another lender, because of, you're obviously saving on the interest of the home loan, and so that is definitely a prudent thing to be looking at.
Yeah, I think from my perspective as well, so you mentioned the interest rate, which is one of those things that, yes, from a numbers perspective, you're going to look at it and say, okay, over the life of the loan, I'm going to pay. You don't want to do this calculation because you're going to pay hundreds of thousands of dollars in interest. But that's, for me, not really the driving reason why people do it. First and foremost, it goes something like this. You get a letter in the mail or a text message or, through your online portal or whatever it may be, that your interest rates have gone up and your repayment will go from sort of this to that in the following month or whenever it becomes effective. So it's a cash flow implication first and foremost that I think people experience. And then when you go through and multiply that out, what the impact is in terms of how much more interest you'd pay, that's when you see the interest portion. But for me, it's always been a cash flow play first. Yeah. And especially, at least in Australia anyway, where we've seen these rapid fire interest rate increases, where we've gone from what was a really, really low interest rate environment, and it's the same pretty much across the world, let's be realistic, but you're moving into, I guess, a more normalized position, but the pace that's happened has been really, really quick. Obviously, because all the central banks around the world are trying to combat inflation, but it doesn't give people a lot of time to adjust to it. So we're finding that it's the cash flow pressure first and foremost that's sort of triggering that conversation to get your home loan looked at and your interest rate reviewed.
Yeah, exactly. And when you're reviewing it, something that a lot of the times can be overlooked as well, and it's for a variety of reasons, but one is also from simplicity, ease, is don't forget to try and negotiate with your existing lender. If you've got the ability to not have to go through the entire process of refinancing, which is labor intensive, cumbersome, can have other implications as well, and you can just negotiate with your existing lender for a cheaper interest rate, that's another option and another way that you can, achieve the same thing without having to go through all of the other stuff that comes off the back end of it as well.
Yeah. And that's, effectively you'll get hopefully the same result if they come to the party, and it's just literally a call to your broker or a call to your bank if you've gone direct, and hopefully that should get the process started. But once again, if that doesn't work, you consider the refinancing option. So
yeah, definitely.
Fixed versus variable home loans, there's obviously a big difference between those, especially at the moment.
Yeah.
I think everybody's wishing that they were on a fixed rate. Although they're talking about this fixed rate cliff that's coming up early to mid next year. So what are we looking at when we're talking fixed versus variable?
Yeah. So look, variable rate is exactly, as it sounds. The bank has the ability to increase or decrease the rate depending on what the RBA is doing and their, how much they're borrowing money for, in essence. A fixed rate, generally only fixed for a period of time. So, some can be 1, 2, 3, 4. Sometimes I've even seen up to 5 years fixed. But it's a specific rate that's offered at the start of the refinance process or the loan term, where the interest rate will not increase until the fixed term expires. So if you've got a 2-year fixed rate and you borrowed at 2%, not all that long ago, but feels like a lifetime ago now, then for the next 2 years you're only paying a 2% interest rate. Once that expires and once the fixed term ends, that's when you'll start paying the variable rate. So when Billy was talking earlier about, the fixed term cliff that's, on the horizon and, looking to happen, what he means by that is people that have been on fixed rate home loans for, let's say the last 6 months, their home loan rate or their interest rate on their home loan hasn't been increasing. So they've been paying the same amount as what they were paying before the RBA decided to start increasing rates. But eventually, at some point in time, whether that's in 6 months' time, in 12 months' time, depending on when all of those fixed terms expires, you're going to see a massive spike in the interest rate and in the interest that's associated with the home loan, and you're not going to have that progression that you normally have in a variable rate as that's happening in real time, despite the fact that most people, even on variable rates, haven't really had that much time to adjust either. But
yeah, so the theory behind this is that the spike in cash flow requirements going from a fixed 2% interest rate to a 4% variable rate is going to be a huge adjustment for households who are converting from fixed to variable rate.
Yeah. And I think a really important thing to note, because, look, you can go down the route of a fixed home loan or a fixed interest rate for a variety of reasons. One is, it doesn't matter what happens with interest rates. I just want to know that, first time I'm taking on a home loan, I want to know what my repayments are and I want to know that they're not going to change. So it's a mentality thing that, you know exactly what you're up for a period of time until you go into it. Another reason that people go down the route of fixed is if they're expecting interest rates to increase in the future. So if you're expecting rates to rise, then you can go down the route of a fixed rate home loan, because it does mean that, you're not going to experience that rise. The important thing to note within that, however, is let's say you've got a fixed home loan for 2 years and you can fix it at 6% and currently interest rates are at 5%. If in 2 years' time, at that point in time, interest rates go to 6.5%, you're not in fact better off, because you've been paying 1% more for, a year and 10 months, and it's only the last 2 months that you've got the benefit of having a fixed rate that's lower than the variable rate. So the timing and the rate of interest rate increases will also determine, the viability and the benefit of going through a fixed rate as opposed to a variable rate. So an important thing to note if you are trying to, time it and get in at a cheaper rate because there's an expectation that rates will rise.
Yeah. That's a difficult one to do because you just don't know what's going to happen. So I think just probably tying a bow around the fixed rate stuff is going for a fixed rate, not necessarily because you think you're going to time it and you're going to be better off. That could be a consideration, don't get me wrong, but more so from a cash flow perspective, that if you want certainty about what your repayments are going to be for at least that fixed period, that's the first and primary consideration, I think, from a fixed point of view, to give you certainty, especially in an environment where interest rates are moving. at least you know that for a period of time, this is what it's going to be.
Yeah. And consider as well, if you're planning on selling a property in 12 months' time and you've got a 2-year fixed rate, there could potentially be break costs and things like that. So making sure that you're, taking into account your own broader scenario and your expectation around what you're going to be doing with that property as well.
Yeah. Talking about cash flow, obviously variable interest rates change the cash flow requirements. Let's talk about principal and interest versus interest only and what the difference is between those two and why somebody would go for one versus the other. I think the terminology behind it's pretty simple. Is interest only, we'll start with that one because it is simple. You're just paying or servicing the interest on the loan. You're not actually paying the loan back, which in the principal and interest sort of name, it's the principal component. Yeah. So as an example, you borrow $1 million, there's a 5% interest rate. If you're paying an interest only loan, it'd be $50,000 a year at 5%. At the end of that year, your loan is still $1 million. You haven't reduced the loan at all.
Yeah. And much like a fixed rate, it normally has, you can't go on interest only for the 30-year loan term. It's only for a period of time. So it's only for usually a couple of years.
Yep.
That you're on an interest only. Mm-hmm. There's and in comparison to that is principal and interest, where you're actually making principal repayments to pay down the loan over that period of time and over the life of the loan. So ultimately, your repayments are going to be higher on principal and interest, but you're actually paying down the loan, whereas interest only, your payments are going to be lower, but you're not actually physically paying down the loan at all.
Yeah, so on a principal and interest loan, you're still making one repayment, but inside that repayment, there's actually a sort of a split between the interest component, because you still need to service the debt, and the principal component, and the lender works that out. Essentially, they're doing it on a daily basis, and working out net of offset and things like that. We'll talk about the offset account in a minute, but it's reducing the principal while still servicing the obligation of the loan, which is to pay the interest.
Yeah. And so, given that fact, is there any reason why anyone would go down interest only? Do you have any argument for interest only?
Look, my first and primary stance is always principal and interest. That's just sort of my position as an advisor. The reason why you'd go, and just on that note, because I think that fundamentally, if you borrow money, you should have an obligation to pay it back, not just service the loan from an interest perspective. So that's kind of my own personal stance on it. The reasons why you'd go interest only, one, primarily from a cash flow perspective, if you want to try and take out that loan and secure that asset, but you want to manage your cash flow. That would be one thing. And in that instance, it'd be very specific in my mind why you do it. I know there's an argument that buying investment properties on interest only, the interest component is tax deductible. I get all of that. But the problem is you're kicking the can further down the road. The only time that I'd really consider it in that instance is you go an investment property and say your repayments under a principal and interest loan would be, $2,500 a month versus interest only at $2,000 a month. If you've got a owner-occupier principal and interest home loan, I would say take that extra $500 that you were going to make on the investment property, on the investment loan, and put that into your non-deductible owner-occupier home loan.
Yeah.
That would really be the only time that I would do that, because what you're trying to do in this instance is you're trying to use additional cash flow to pay down your owner-occupier non-deductible debt first. But once again, the reason why I don't like that, as in setting up interest-only loans, is because it needs discipline to be able to do that. And, you may take that extra $500 that you've got, and rather than putting it into your mortgage like you should be doing, you might use it as discretionary spending.
Yeah.
So I just prefer to take that out of the equation and just say, everything is on principal and interest. And if you can't afford to pay it back on P&I, arguably in my mind, maybe you shouldn't have the loan.
Yeah.
That's my take on it.
Yeah. Offset accounts. What are they? How do they work?
Offset accounts. So pretty straightforward, I think, in my mind. When the lender calculates and we're talking about a variable rate here, but when the lender calculates your repayments in terms of the split between principal and interest, they will take the offset money into account when they're working out the loan balance to calculate the interest on. Now that was a bit of a mouthful. So let's go back to the example. You've got a loan worth $1 million and you have whatever your interest rate is, call it 5%. So you're paying interest per year of $50,000.
Yep.
You've got principal repayments on top of it, but just ignore that for a minute. Let's just say you've got $100,000 in your offset account. Your interest is now being calculated on a $900,000 balance, not $1 million balance.
Yep.
So using that as an example, at 5%, you're talking $45,000 worth of interest rather than 50.
Yep.
So it's using it to offset the interest that you pay. Your contracted loan repayments will still be the same, but that split that I was talking about between the interest that you pay versus the principal, essentially what it will do is it'll just reduce the interest payable and the principal portion will increase.
Yeah. So you're paying down your loan faster because you're, in essence, having a higher principal repayment than the interest repayment associated with that loan.
It's not impacting your contracted loan repayment amount. It's just the internal split between the interest portion and the principal portion that's changing.
Yeah.
And what it does do is you're paying less interest, so it puts more into the principal, and essentially it accelerates your loan repayment schedule.
Yeah. And the benefit of doing that in an offset account as opposed to physically paying down the loan is that you've still got access to that money. So in an offset account, you can still draw that money out. You can use that $100,000 on either a deposit on another property or for whatever you like at a future point in time, as opposed to physically paying down the loan, whereby you can't actually draw that money out unless you decide to, refinance and draw out equity and all of that stuff as well.
Yeah, so you're talking about offset versus redraw. So some lenders will allow you to access the redraw. It's more of a convoluted process with some lenders, whereas the offset account, it's just like it's a liquid savings account that you can dip into at your discretion whenever you want. Depending on which lender you're with and what it is, they may restrict you in terms of being able to take out your redraw.
Yeah.
So if you put that extra $100,000 as an example into your $1 million loan, your loan then is still the way that it was, but you've got $100,000 in redraw, where if you want to access that money, you'd have to essentially access it, contact the lender depending on their restrictions, versus the offset account. It's just like an everyday transactional account, but it's doing the same thing. From a mathematical perspective, it's identical.
Yeah. However, from a tax perspective, it can have some implications. So make sure that you're speaking with your tax advisor, because when you are drawing funds out of a redraw account, if it's an investment property and it's not used for an investment purpose, that amount of money or that additional funds that you've pulled out of redraw is no longer tax deductible, as opposed to in an offset account where the purpose and use of the funds, it's irrelevant. It's where the loan is sitting again. So making sure that you're receiving tax advice on if you're going down the route of putting funds in redraw versus offset, there can be some tax implications associated with that as well.
Yeah, so once again, getting advice to make sure you got your structure set up correctly is absolutely critical, because you want to get it right.
Absolutely. Now we're talking about the big stuff, the big thing that everyone kind of, I find, forgets about when they're looking at refinancing, when they're looking at all of this, which is the loan term.
I have spoken about this so many times, and every time I do it, it kind of blows my mind away. And even thinking back to a couple of times before I was in this profession, many, many years ago, thinking about this process and refinancing, because that's what you do when you save money, but not realizing the unintended consequences and the detriment that if you're not aware of it and you're not doing it correctly, the impact that it could have. I think we just jump straight into it and we'll talk through it and talk about some numbers associated with it. But essentially, Andrew, what we're talking about is you're with a lender for a particular period of time and then resetting your loan term back to 30 years, because that's your standard loan term.
Yep.
And not paying, enough attention to what the resetting of that loan term is. As an example, maybe being with a lender for a period of 2 years and then resetting it or refinancing with another lender and turning a 28-year term into a 30-year term.
Yeah. Yeah, I think the best way to explain it is to literally go through, some examples of what the actual implications are, because
good idea.
It's huge. Like the implications are massive. So, and again, similar, just blows my mind every time we run through these numbers, but let's just assume that, base scenario is, you've got a home loan, you've been in that, or you've been with that, or in that product for 5 years.
Yep.
So you've got a 25-year loan term remaining. It's a $600,000 loan, and you're paying 5.5% in interest on principal and interest, right? So $600,000 loan, 5.5% interest rate, principal and interest, 25-year loan term. Under that scenario, over the life of the loan, you'll pay $505,000 in interest. This is just the interest component. So in essence, you're not paying back $600,000. You're paying a bit over $1.1 million over the life of the loan. Now, you go, you see, your bank, your mortgage broker, whatever it is, and all of a sudden, you extend that loan term, but don't actually make any difference to the interest rate. So this is scenario 2. So $600,000 loan, you're still on 5.5% interest rate, but you then extend the loan term from 25 years to 30 years. Well, now the amount of interest that you're paying on that very same home loan is $626,000.
So that's an extra $121,000 for the 5 years.
Yep. So you've extended your loan term, your repayments are cheaper, you feel better from a cash flow perspective. However, you're now paying $126,000 extra in interest. Now that's probably a relatively unrealistic scenario, because most of the time, if you're refinancing, you're doing it for a cheaper rate. So you would think cheaper interest rate means I'm paying less interest over the life of the loan. But let's go through the numbers.
It's got to be a Warren Buffett quote in here somewhere.
I'm waiting for you to try and find one. You said in the last podcast that you're going to slip in a Warren Buffett quote in every episode. Or maybe we've missed it and you have. $600,000 loan. It's the same loan balance. But now you've refinanced and you've gone from 5.5% interest to 5% interest. So you've reduced the interest by 0.5%, which is pretty decent. I mean, you're talking about, 10% interest saving.
Yep.
So lower interest rate, but then you've extended your loan term to 30 years, which I don't want to say, all of the time, but most of the time when people are refinancing, this is usually what they're doing, and this is kind of the sleeper in it all.
It's a fair thing to say because it's an industry standard.
Yeah.
And from a contractual perspective, it makes sense because you want to leave yourself as much room as you can by lowering the repayments, the contracted repayments, in case you need some wriggle room.
Exactly. Yeah. In that scenario, you're actually paying $559,000 in interest over the life of the loan. So in essence, you're paying almost $55,000 more in interest, despite the fact that you had a 10% reduction in interest rate, or a 0.5% interest rate saving.
Yep.
So in your mind, you're thinking, great, I'm refinancing.
I've done the right thing.
Yeah, I've done the right thing. I'm reducing my repayments. I'm reducing the interest rate that I'm paying. But by extending the loan term from a 25-year loan term to a 30-year loan term, all of a sudden you're paying, $55,000 extra in interest over the life of the loan. You've done a disservice to yourself.
Yeah. And I guess all the things that people think about is refinance to get a cheaper rate, which will equate to cheaper repayments, which is a pat on the back from a cash flow perspective. So you see the headline number in this instance going from 5.5 to 5, and then going, my repayments were this and now they're that. I've done the right thing. But when you break it down and extend it out, if you're not careful, and this is the other thing, this is just one example of resetting the loan term after being with that particular lender for 5 years. I'd say throughout the life of the loan, you're probably going to refinance 3, 4, 5 times.
Yeah, I mean, I don't know. Most people that I see are refinancing every couple of years. So you're talking about redoing this process every couple of years. And even if you're doing it 5 or 6 times, the implications are massive. And I think that this is a really huge sleeper in the process of refinancing and in home loans and all of that stuff, because the implications are massive.
Yeah. Andrew, what do we do? How do we prevent this from happening?
So when you're refinancing, make sure that at the very least, you're matching your loan term. If you've got 25 years left on your existing loan term and you're refinancing for a cheaper rate, match your existing loan term to 25 years. That's going to ensure that you're still paying off the home loan at the same time. Your repayments are still going to decrease, but your repayments are decreasing not because you've extended the loan term, but because you've reduced the interest rate. So that's the way to do it. That's the simple fix, is match your existing loan term and make sure that you're doing that each and every time that you're refinancing, because it's very easy to get caught out.
Yeah, it's such a simple thing. And I guess the challenging thing from an industry perspective and from a broking point of view is the longer the loan term, the easier it is to get the loan and the numbers to service. So if you've got somebody who, is a little bit tighter on cash flow or whatever it may be, they may not be able to service with a new lender under a 25-year term, using your example, but they may be able to do it over a 30-year term. So that's the challenge and the intricacies that you need to, I guess, deal with and contend with, but needing to make sure that you're aware of whatever decision that you make, and whichever way you go, needing to make sure that you understand, one, why you're doing it, and two, what are the, I guess in this instance, what are the unintended consequences? If it's purely for cash flow because you're trying to give yourself a bit more breathing space and you say, you know what, I'm more worried about the short-term implications about my cash flow, which obviously makes sense, and I'm prepared to pay a little bit more interest, and I'm prepared to extend the loan term for a bit more just to give me that breathing space at the moment. Maybe my wife's on maternity leave or my husband's on paternity leave or whatever it may be. If that's the case, fair enough, no problem. As long as you're aware of it and you can make an informed decision.
Yeah, exactly. Or another thing that I've seen a client do, which can, you put this all, or you turn it from a negative into a positive, is, okay, my repayments at the moment are $3,500 a month, let's say. I can afford to make $3,500 a month in repayments. That's perfectly fine. It's doable, but I know that I can get a better deal elsewhere from an interest rate perspective. So you refinance to a cheaper interest rate, and you actually decrease your loan term. So this client went from a 28-year loan to a 26-year loan, refinanced, kept the interest or kept the repayments the same, dropped the interest rate in order to actually reduce the amount of time that you're paying down the loan, because, hey, I can make these repayments, it's comfortable, but I'd rather do so knowing that I'm actually going to pay down the loan quicker and faster, and force myself to do it rather than needing to think about, putting money into redraw offsets or anything like that.
Yeah, and usually that type of thing works with, I guess, an investment plan or a financial plan. And generally when we do this, it's around a particular milestone age and saying, okay, I want to be debt-free by the time I am X, working it back. And in this instance, that great outcome. Obviously the cash flow implications wasn't too big of a deal for the client, so that was great. But worthwhile strategy in that instance.
Yeah, absolutely.
Andrew, I think we got that point across.
Yeah, absolutely. And hopefully there's, a whole heap of value in that one, because we think that it's absolutely massive and it's something that everyone should be considering every time they're, going through the refinance process.
Absolutely. So viewers and listeners, if there's anything that you wanted to have a chat about or you need a bit more information on, feel free to reach out. We're always happy to talk you through it. And on that note, Andrew, thank you. And
Thanks,
we'll catch you on the next one.
Yes, look forward to the next podcast.
Thanks for listening today. If you have any questions on what we've talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.